we buy right, we can make money on day one. In this video, I want to go through exactly how we know if a property is a good investment or not. When you are looking for property, it can be a minefield and it's hard to know what a good deal looks like. How do you bring yourself that confidence that yes, this is the right deal for me? I'm Katie, founder of KO Estates, helping clients on their property investing journey. When you are investing in property, you have worked so hard for that money. We want to make sure we are investing it in the right place. We want to make sure we are maximizing our money's potential and get the best results from it. So this is so important when we are buying our investment properties. Okay, so at KO Estates, we are an investment agency. Our job is to find killer deals for our clients. Now, in order for us to do that, we need to know what a good deal looks like and be able to find them and find a lot of them because we've got a lot of clients to help. So due diligence for us is absolutely massive because we need to make sure our investors are winning from day one. And it's all done in that due diligence stage, all part of the number crunching. So I'm going to break down the exact steps that we go through to make sure we have a perfect deal for our clients. There's 4 main stages that we go through any property due diligence process. When a property initially comes in, it's all about the numbers. We have to do the number crunching because as an investor, we are very led by the numbers. It's more of a head decision than a heart because we are in it to get a return. We are in it to work our money. Whereas when you are looking for a property for yourself to live in and to buy, it's more of an emotional purchase. It just wants to feel right, like you want to be able to get excited about it. Whereas an investment is slightly different because it's less important that you fall in love with the property. You want to fall in love with the numbers. So that's why we start here first and see, is it actually worth exploring? Is it worth going any deeper on this? So we start with the number crunching, and that's using the calculators, doing all the numbers to see, is this going to be a good enough return for the amount of capital that I'm putting in? Now, at KO Estates, we've developed all our calculators to make sure nothing is left unturned. And that is the easiest way to do it because I think when you are doing numbers, it's so easy sometimes to forget. There's so many different fees involved in both the purchase and the ongoing management that you just can't forget because it will massively affect the deal. So having those calculators in place massively help the process. Not also do we need to be able to do due diligence and number crunch, but we need to do this at speed because a good deal does not hang around. So we need to be able to see a deal, review it, and know instantly whether it's something we're moving forward or not. Like, it's so quick, this industry. Things go on Rightmove one day, they're gone the next. We need to be so quick to keep up with the market to make sure we are getting the best deals. So not only do we need to know how to number crunch, but we need to be able to do that quickly in order to grab the best deals. Once we have worked with the numbers, we're comfortable with it, and it's looking like a really great deal that we want to move forward with, we also look at the past history data. Now, we can never predict the future, and anyone who can tell you they can is rubbish. Like, who knew we were going to run into COVID back in 2019? Like, we just did not see it coming, and things come along in the market that just no one could ever predict. So although we can never predict the future, all we can go off is past data and the history to see what has happened in the past, which may help us understand what could happen in the future. Our next stage then is to understand the market as a whole of where that property or that deal is located, looking at the capital growth and for all the previous years to see the general trends. If it's obviously going down, that's alarm bells, but also it needs to be put into context with the entire market. For example, one particular deal, you may have seen it go down in the last 2 years, but if the entire UK property market has gone down in the last 2 years, then that makes a little bit of sense. What would be a bit more worrying is if a particular location has gone down in the last 2 years, but the rest of the UK is thriving and going up. That's an instant red flag. That's alarm bells. You're thinking, why has this not followed the patterns of the rest of the country? There's something going on here. And that's where we investigate it a little bit more. So Stage 2 is all about the past data. what has happened, market trends, understanding the capital growth to see what we could predict going forward. Next up is comparables. Comparables are incredible at telling you as a buyer, as an investor, am I getting good value for money here? What is a good deal and what does it look like? What is market value for this property? Because if we are buying below market value, we are winning from day one. If a property market value is 100,000 and we're buying it for 80, the day we buy that property, we're up 20,000. We've already won. We've had a huge win on day one. So if we can do that, that is incredible. But we actually need to know what market value should look like in order to know whether we're below market value or not. And that's where comparables help us to build that picture. So we are doing all the research in terms of local sold prices, all the different stats of that particular area to understand what the going rate for that property should be. Now, this is really tricky because as with any area, you could have an incredible location and only 2 roads down, it be a really different market and a completely different area to be in. So we want to make sure our comparables are actually located super close to the deal itself. That way we actually know we're comparing apples with apples. Likewise, we want to make sure we are looking at semi-detached, if our deal is semi-detached, the same amount of bedrooms, and be as specific as possible, because a 1-bed bungalow is not really much help if we're buying a 4-bed detached house. It does not help us paint the picture of what our property should look like. So in comparables, we try and get the very specific, as close as we can to the property, to build out that picture of what market value is, so that when we're going into the negotiation phase, we know what we should be paying, and we ideally want to be getting it below that number so that we're winning from day one. And then one of the final pieces of the puzzle of our due diligence stage is viewing. Viewings are so important because there is so much that you just cannot see online. Now, online, I am the biggest fan. You can Google Maps, you can literally feel like you're stood in the street. But if you are investing in a property, I would massively advise that either you or someone you trust goes into that property to check it out, because going into a property unlocks so much data that you just don't have online. You walk into a property and you can smell if there's damp, you can see, whereas photos can be cleverly placed. There's things that the photos can definitely miss based on the property. So going to a viewing and going through a checklist and checking the roof, listening, is it a really noisy street? Are we south facing? Is the water pressure good? How old's the boiler? Actually getting into the property and getting those questions to those answers that we cannot find online. Online is perfect for knowing previous sold prices and understanding the market and the data and the numbers. But what it can't do is tell you the exact details of that specific property without you getting in there yourself. So viewing is an important part. We would never sell a deal, we would never invest in a deal without myself or one of the team that we really trust going into that property to make sure that it stacks. Viewings bring it all to life. And once we have done all the desktop due diligence we can do, this is looking like a great deal, it's all stacking up. That final step is to actually get there and get your eyes on the property to actually see, is this right? And by the time you have done those 4 steps, you have built up an incredible picture of the numbers, which is our number one priority. But then the past data, which helps us predict the future. It helps us to understand the market value so that we know we're getting good value for our money. And finally, the viewing brings it all to life for us to actually know, yes, this is the right deal because everything is as it should be. They are the 4 steps that we go through before any negotiation. We want to go to that negotiation armed with all the information that we have on a property, on a deal, of what numbers are going to work for us, how much money would need to be spent on the property. And that's all done in the due diligence phase to make sure that you are buying the right investment. Buying the right investment is going to set yourself up for life. You're going to hold this property for years and years and years, so you want it to be right, and this upfront work is going to save you so many headaches down the line. It's going to make sure you have the confidence to know your money is being put into the best possible place and that you're getting the best possible deal. Never, ever, ever skip on the due diligence. It's the most important part of the process. I hope that helps. If you have any questions, do let me know.